And I think what we were looking at is that maybe something like a 10% tariff was priced into European equities going into Liberation Day. Obviously, we got larger tariffs than that, 20% on the EU. I think it's interesting if you look into the price action in Europe today, really, this is becoming about more than just tariffs, and it's about the second order effects and a potential growth slowdown coming here, right? In Europe, it's a mix of properly cyclical sectors that are underperforming, even those that have maybe less direct tariff risk like banks. So, I mean, maybe there's still some hope outstanding that trade negotiations are possible and the like, but we need to be thinking about not only the tariffs themselves, but also maybe those second order knock-on effects going forward.
You know, you think about that bid that had been drawn into European stocks since the beginning of the year, and you're looking at a DAX, for example, that is still up about 9.6%. So it's held up even after the tariff announcement. It had been down about 2.6%. You know, is the sell-off more pronounced to come, given the way that these tariffs will be playing out and given the bid that we've seen this year?
Yeah, I think, there's some reasons to still be optimistic, at least in relative terms, on the European story, right? I think the European market had been structurally underowned by global investors for quite some time. Obviously, we've seen a meaningful shift in the policy backdrop. And I think you could also make the argument that maybe the growth hit from tariffs does affect the US at least first, before it spreads into the rest of the world. And I think if we're in this environment where the US is slowing, but the rest of the world is more resilient, that's ultimately an environment that could still favor Europe. But obviously, right, if we spill into an environment where the US is going into a proper growth slowdown, a proper recession, I think some of these higher beta markets like Europe are going to get caught up, right? If the US has an earnings recession, what we found is that over the past 20 years, Europe almost always has one too, right? So you need to be thinking about, is this just slowdown or is this something worse? And I think that starts to question, how long can these high beta markets continue to outperform?
Yeah, David, forgive me for using a cliche, but the U.S. sneezes, the rest of the world catches a cold, at least as you lay out. That has been the story of earnings. But I want to talk about where you might want to hide out. I mean, you wrote in that note that it's autos, tech, basic resources most at risk here. When you take a look at the sector level of the European equity market, where's the best place to hide out, for lack of a better term?
So what our analysis is showing, right, is that if you get a 20% tariff, you probably shave off something like 3% of EPS growth in Europe on the whole, and that's coming down from consensus growth of something like 7%. So you're cutting EPS growth in half. And if you then go ahead and get meaningful slowdowns in GDP growth, I mean, you could see that go to flat to negative, right? So in these risk scenarios where things do get a little bit more, dire, I think that you would be looking at some of these defensive sectors that have less international exposure, right, within the European market. So you're making a little bit of a transition from cyclicals into maybe some of that more defensive and domestic exposure.
You look at companies reacting. It's been less than 24 hours, and yet you do see some significant reactions. Stellantis, for example, halting work in factories in Canada and Mexico, for example, for the coming weeks. David, when you're looking at companies change their plans, they are stopping in their tracks and they're pivoting course. Isn't that going to be expensive?
Yeah, and I think it's something that's difficult, and it's one of those longer-term stories that you need to be thinking about that we've been talking about. When you talk about geopolitical realignment and maybe what it means to shift your supply chains globally, is that over time it makes you more resilient, but at the same time you might face some issues with margins, for instance, over the near term as you make those changes. So you do need to be thinking about not only the short term, but the long term. But obviously, the risk here from everything that we've been seeing, right, is that potentially some of the changes that we've seen in consumer confidence, in business confidence, investment decisions that are happening, is that maybe we've gone too far down the line where it's hard to pare this back. And you don't always see recessions coming, and sometimes they come a little bit more suddenly than you would expect. So we need to be looking at this. Are there the signs of that slowdown that we're looking for, or are things ultimately going to hold up?
Well, a topic that keeps coming up on this show is that Europe has had a bit of a wake-up call, maybe in a positive way. I mean, we had Stefan Seelig pointing out yesterday that you think about the defense spending that has been freed up in Europe. Neil Dutta made a similar point in his note, writing that the Europeans are actually boosting their defense spending, not something you've seen that often. David, I mean, are there any sort of tradable actions that you can make around those sorts of dynamics?
Yeah, and I think this is the key point with the European story, right, is that something has fundamentally changed, at least for the medium-term picture. So, right, if you look at consensus EPS growth forecasts for Europe out over the next 5 years or so, right, it's something like plus 9% growth per annum that's penciled in. It's probably a little bit too high. It might come down over time. But think about that number. If we use our top-down models and apply in a lot of the fiscal spend and the changes that are coming through, what we would see is that you could see EPS growth rise by about 2 to 3% per annum out over the next 5 years. And if you were to assume some ERP compression as well, I mean, you could see Europe going from a market that has traded historically at a multiple of 14 times up to something like 16 times. And obviously, there will be some volatility along the way. And the risks that we are seeing around tariffs right now are certainly one of them. But I do think there is still that medium-term structural tailwind that might be there from the European story coming from this defense spend, also the fiscal spend on infrastructure that we're seeing out of Germany, which are really meaningful.